Hi, I'm Steve Douglas. Welcome along to today's session entitled Australian Property. Is it still a tax-effective and profitable investment option? It's a very compelling question in the latest environment where prices are going up and cost of interest is rising. So hopefully we can deal with it and give you a good idea of what the options are in property investment in the current environment in Australia. We're going to start off with the tax issue, and is it still indeed tax effective? Well, SMATS, we've been the leading property tax advisor in Australia since 1995. So we've helped thousands of people to buy Australian property, invest in Australian property, and it's been tax that has been a driving force, and we still believe that that's a dominant force. And one of the reasons we believe that, very simply, is that in Australia we have a concept of negative gearing. Now, negative gearing is quite simply where the rent from the property is not enough to cover the expenses of ownership and the interest on the loan that you took to borrow the asset. If that results in a negative amount, a deficit, that deficit is allowed as an annual income tax deduction against your salary, against your other investment earnings, and can reduce your tax significantly. Now, importantly, the only logical reason you would do that is if you had full belief that the property could grow in value by at least what it's costing you to keep, and hopefully significantly more. So you get an annual tax deduction now with wealth creation through the property appreciation in the future. Without that property appreciation, negative gearing is a crazy pursuit. So without the real belief that you can get growth, you should not do any negative gearing. And we'll talk about the profitability element of that later in today's session. You also get, as a property investor in Australia, significant depreciation allowances if you buy a property and rent it out. Now, if it's brand new, they're at the maximum level. That includes the writing off of the carpets, the stove, the kitchen items, all sorts of appliances. So that's a really, really good tax write-off in addition to the annual holding cost. And it can boost your tax deduction and your tax refund significantly. And then in addition to that, you can also write off the construction cost of the property at 2.5% of the original cost of construction. Now, if you buy a second-hand or established property, they recently did take away the depreciation benefits on the fixtures and fittings in the house, but the building deduction is still there for up to 40 years. So you want to really take full advantage and buy newer if it is a good property. In addition, you want to think about it. If you're struggling to afford the property that you want to live in, one of the great options you've got is to maybe buy it as an investment property at the start, get the support of the tax system to give you the cash flow to afford it, and then wait till your salary increases or you'll get to reduce the debt sufficiently that you can move into that property with a more manageable mortgage, but at least you locked it in at today's price and you didn't have to worry about it getting further and further more expensive and harder to acquire. In the same breath, if you're a downsizer, if you're currently in a house and you think you might sell it later to shrink down your lifestyle, buying your downsizer sooner as an investment is a really good strategy because you get to buy it and lock it in at today's price and stay in your house letting it keep going up and up in value. So that when you eventually sell, you can sell your property at a higher price and have the same original purchase price of the downsizer you acquired potentially many years earlier, giving you a bigger gap which you could use to top up your super, pay out the downsizer, renovate, help the kids, and many other options. So that's a really good strategy if you're thinking about downsizing. And the key there is that we lock in today's price rather than tomorrow's. In the whole 30 years that we've been doing this with our clients, our motivation has been to how do we get you low debt, no debt on your home. And the one thing we learned is by buying it today, it's usually cheaper than tomorrow. So whatever you're thinking about buying, investment, future home, downsizer, the sooner you buy it, the cheaper it's likely to be because the underlying drivers of the property market in Australia continue to support positive growth in price. And we'll talk about that in detail soon. Furthermore, when you invest in Australian property and other assets in Australia and keep that asset more than 12 months, then half of any gain is fully tax-free when you do eventually sell. Now that means it's encouraging you to get an income tax deduction now at 100% and then pay tax later on the gain at only half taxable. So there's a really good timing advantage there for you if you can take that into account. And of course, these days it's getting harder and harder to borrow money. And one of the reasons for that is price points on property is getting higher and higher and higher. So the amount of loan is getting larger and larger. So you want to be getting in as soon as you can whilst it's still in range before you're told you can't afford it and you can't get the loan and you're left on the sidelines. One of the other big advantages with Australian property is if you live in it, the period you lived in it is tax-free entirely. And there's no limit on that. So whatever you make can be fully tax-free. Now, if you rent your house out for a period, it may be pro rata tax-free. Now, but there are rules there that mean that you can buy it, live in it, move out, and there's periods that you can rent it and still stay tax-free for up to 6 years. So there's some really good advantages if you're moving around the country, going overseas, and you need to talk to us if you have those circumstances because they make it very encouraging to be a homeowner in Australia. It's pretty much your only tax-free return in Australia, and therefore it's highly valuable to have your own home, and it's most desirable. One of the reasons that Australia has one of the highest owner-occupier rates in the world. And right now, the property market in Australia, particularly for investors and rentals, is seriously tight. So we need investors to come into the market to help keep rents affordable, manageable, and more particularly available. The vacancy across Australia, as you'll see later, is at the lowest historical levels ever. And that keeps it safe for us to go into the market. It encourages investors, and we desperately need investors to come in and support that market. One thing we do need to be mindful of, though, which has changed significantly over the period that we've been doing this, is land tax. Now, land tax is something that most Australians don't even know about because you do not pay land tax on your family home. But if you have an investment property rented out, then that is subject to land tax. Now, even with most people, if you have an investment property, you're probably not paying land tax in the past because there's an annual threshold that if your value is underneath, there's no tax to pay. But what's been happening behind the scenes, by state governments in recent time, is those values have been creeping up and up and up. And now many people are being pushed into a land tax bracket, and some of those land tax bills are significantly high. It's quite mischievous in my mind that the governments are doing that because that is adding to the cost of ownership of a rental property, adding to the cost of pressure on the landlord, which he then has to pass on to the tenant. So even though you see the government saying, hey, we want prices to come down, we want rents to be affordable, they are at the moment one of the largest contributor to increased cost in the rental market. So if they were serious about affordability, they should be lowering or eliminating land tax, not charging more and more and more every year. And then recently, we've also seen a surge of foreign investor surcharges, both on land tax and also acquisition stamp duty. Now again, if we are wanting to take pressure off the market, we need foreign investor support. And one of the reasons for that is foreign investors can only buy brand new property. So it means we're increasing the stock pool of property, increasing the number of rentals, increasing that. And foreigners generally don't get to use their property because they live overseas. So they're a critical element. Now we need to protect those, but the governments have not been encouraging them in recent years. I wanted to show you this graph because there's a lot of misconception in the property market. One of the key things is that foreigners, there's a theory out there that foreigners are pushing prices up, and that's simply not true. And the reason I say that is because a foreigner, someone who does not have Australian citizenship or a permanent residency visa and living overseas, cannot buy an established Australian property. Under our rules, they must buy a brand new property, either an apartment or build a house. So they're not going to auctions in your local area and buying up properties at ridiculous prices because they legally can't. If you are seeing someone who looks like a foreigner at a local auction, chances are they are a new Australian, not a foreigner. And they are en masse, they're coming, our migration is very strong, but they are not foreign investors. Now, foreign investors have been critical in our market for years and usually average about 5,000 to 6,000. But there was a surge in the late 2000s where we saw up to 30,000 foreigners buying properties. Now where that worked well is they were buying the apartments, particularly in Melbourne and Sydney, and they were bringing mass new stock into the market, probably too much for that matter. But what it did do is it created a large rental stock, it took a lot of pressure off and kept rents very affordable. Now what we've seen since that occurred is the state governments have said, hey, that's a golden goose, let's go and raid that cash at federal and state level. And you can see the costs now of buying property are escalating all the time. Now for foreigners, they're paying 7 to 8% additional stamp duty over and above the normal stamp duty that all of us investors pay, foreigners and locals, of around 3 to 5% depending on where you buy. Now, again, if you think about it, this is 3 to 5% of the current pricing, and prices in Australia have moved upwards regularly over the last 10, 15, 20 years. So if you think about it again, it's the government that is making home ownership more expensive for both owner-occupiers and investors because they're leaving stamp duty rates at their current levels, but on higher and higher and higher prices, meaning the stamp duty on entry is going up and up and up to crazy levels. If they were serious about making it affordable, they could reduce it as a percentage on the higher amount and keep it at a similar level. Furthermore, the only way we can help the property market and the rental market is by bringing in new stock. And what a lot of people forget in Australia is that stamp duty is there for everything we buy, but anything that is newly built from a developer also has GST in the price. Now the average is about another 6-7%. So if the state governments really cared about affordability, they should probably only take either stamp duty or GST. So they could, for example, exempt any brand new property from stamp duty because they're already collecting 6 to 7% GST in that purchase price. So that would be a big step in the right direction. But all of these things are making it more and more expensive for foreign investors, and it's no coincidence that we are having a rental supply crisis in Australia when they have attacked a significant contributor of quality rental stock investment in there. Thankfully though, if you are an Australian citizen or a permanent resident living in or out of Australia, you are not paying these foreign surcharges. There's usually some confusion as to whether or not Australians living abroad have to pay it, and they do not. But you can see it's very expensive now for a foreigner to invest, and we need to encourage that investment if we are going to get rents and affordability there. The fact that they're not giving them any concession, the fact that they're charging them more and more, actually helps every other Australian property investor because they're sitting on the sidelines and we're going to keep lack of supply for an ongoing basis. One of the things I really want to talk to you about is the real cost of interest. Now this is one of the critical elements, particularly in our property market, that most people get wrong. Now interest is a necessary evil usually when buying a property. Very few of us can pay cash for a property. If you can, lucky you. But most of us have to take a mortgage. And of course, we're now living in an environment where interest rates have risen from the COVID lows, where they were 2-3% on your loan, and it's back now at 6 to 7%. Now again, just a reminder, we haven't seen rates rise, we've seen them come back to normal. COVID took them down artificially. It was inevitable they came back, and that has happened. But what you have to understand is there is a difference between private debt in Australia and investment debt. If you borrow money to buy a house that you are going to live in, that is not tax deductible, and therefore when you go to pay the bank, you've got to earn pre-salary money in order to give the bank their interest. Now if you think of it as an example that $1 of interest you had to pay the bank, if you were on the top tax rate of 47 cents, you need to earn roughly $2 in order to pay the bank $1. And you'll see here that in doing so, when you're at the top tax rate of 190 and over, that 6% factual interest rate is actually costing you 11.49% on a post-tax basis. So you're actually earning $2 to pay $1, so 6% really is costing you 11.4. Now, it's hard enough to pay 6, it's really hard to pay 11.49. And hence we want to reduce the amount of private debt we have wherever possible. But in the same breath, if you can recycle that debt and make it investment debt, which is basically meaning you're buying for a property that is income producing, i.e. rented out, or investments in shares or anything else, then all of a sudden that 6% cost, if it's used for investment purposes, the tax office says, hey, let me give you a tax deduction on that. And as a result, your effective after tax cost at the top margin rate is 3.2, and even at the lower rates, 4%, 3.7. Much better than if it's non-deductible at 9%, 10%, 11.5%. So the key here is we want to try and eliminate private debt and maximize investment debt. And we do that with a simple strategy of reduce, redraw, and reinvest. When you start your loan, it's likely that you're going to have pretty much the whole amount when you buy a property used to buy your family home. And you have very little for investment. But over the period of time, what you're trying to do is reduce this loan as fast you can, and then slowly redraw what you pay back in advance so that part of the loan becomes investment at the cheaper and lesser of the loan becomes private, which is more expensive. And hopefully the mission is at the end of the day, we move to a situation where there's little or no private debt and your loan is maximized for investment. Now, this can be done by buying shares, buying another property, selling it every now and again, and using the profits to reduce and then recycle. And that's really the mission that every Australian should be on. Get into your home, get in whatever you can do, and then start to work a way that we can reduce the private debt faster than necessary so we can access it in order to invest and improve our tax scenario. That really is the key concept that everybody should be thinking about in Australia if they can. In doing so, one of the things you could do is you can go around and when your house goes up a little bit in value and your loan comes down a little bit with repayment, you start building equity in that house on a regular basis. And if you've got equity in your home, you can use that equity, hopefully, as a deposit towards your next investment property per se. Now, that becomes critical because you can use it to borrow 100% or more if there's enough equity in your house. So as soon as you have enough equity, you should look to recycle it for your next property. Now, critically, you cannot borrow 100% on a property, but the bank will lend you usually 80% of the combined value of all properties, subject to servicing. So they'll check and make sure you can afford it, but if you can afford it and there's enough equity, they will let you do it. Now, normally, I'm going to go and give you an example of $1 million property. Normally, what would happen is if you bought $1 million property for investment, and again, don't worry about the amount, it's the percentages that will matter, but if you bought $1 million property, you would normally have to commit 20% in cash as a deposit. But that 20% cash can come through equity built up in your current home instead of. In the same breath, if you had the opportunity where you were lucky enough to have the cash and you say, oh, look, I can put it down as a deposit on the investment property, I would say don't do that. Take the cash, pay it off your family home if that still has a mortgage, and then redraw it as I just showed you so that the redraw is used as your 20% deposit, and therefore we're maximizing your tax deductible debt. Now, importantly, the tax office looks at where the money went when the bank gave it to you. So if you take your cash and reduce your home loan and then use your home loan to get the money back and buy the investment property, the tax office looks at when he got it back. It says you bought an investment property. If that's rented out, you can get a tax deduction for that interest. And that's critical in reducing that debt, into an investment debt, lower interest cost than private debt higher. Very, very important. So in this example, what I'm going to assume is that you've been lucky enough to have bought a property over time. You've got some equity build up, and we're going to recycle that debt, and we're going to go borrow to buy a property for investment, and we're going to borrow not only the 100% purchase price, but we're also going to include the 5% costs. In doing so, what happens is you'll have a situation where we have to declare the annual income each year. So we'll have rent coming in here, approximately $50,000. And then you have all the costs of ownership, which are tax deductible for you, including the interest on the loan, which in this case is 105% of the purchase price. So you see your total costs in this situation are $80,000 and your income is $50,000, and therefore we are negative geared. The income is not as much as the expenditure. There's a $30,000 holding cost, which is a lot of money. Now again, whether you can afford $1 million investment or you can only afford $500,000 or you're buying $3 million, the numbers are roughly the same. And importantly, this $30,000 a year is approximately 3% of the purchase price. So if you're out looking for an investment property to buy, you know that it's going to cost you approximately 3%, being the rent minus the interest minus the cost, if you borrowed the full amount. If you borrowed less, then you'd be lucky enough that that would come down a bit. But this $30,000 will be tax deductible for you, and I'll show you how much that'll save in a second. But you can see if you bought new, in this case, or near new, you would also get the depreciation on the construction. You'd also get the depreciation on the fittings in the house. So your tax deduction increases from the $30,000 cash outlay to a tax deductible paper amount of $46,000. Now where that's important is that if we were going to get a good tax refund at 30, we're going to get a very nice tax refund at 46. Now the Australian tax rates range from 16 to 45%. So you will get back, somewhere between 20 and 47%, including Medicare, as a tax refund, which I'll show you in a sec. But importantly, if you were lucky enough that you had already paid off your home loan and you had spare cash and you didn't have to reduce your home loan, you might have only borrowed 80%. And you see, if you had done so, your net holding cost would be less. It would be $15,000 a year, not 30. Now, that's assuming you just borrow 80% of the purchase price. So you put your 20% down as a deposit and you cover the 5% entry cost of stamp duty. Now you can see that saves you a lot of money, but bear in mind, you've put an extra $250,000 of cash in, where borrowing the whole amount, you put no cash in. You're just servicing the shortfall rather than topping up the entry price, depending on your circumstance. Where this is critical is that as long as we believe that 3% is capable of having property growth, everything above 3% growth is profit to us. The Australian property market should easily give you 5, 6, 7%, depending what you buy, where you buy it. So that should easily be able to handle the net cash cost. But before you figure that out, that net cash cost is without tax support. And importantly, if we have borrowed that money, pay the expense, we can claim this as a tax deduction against other incomes, salary, investment, business income. And you can see here, depending on your tax rate, if you've got a 16% tax rate, which is basically up to about $40,000, you would get an $8,000 tax refund. And all the way up to, if you're on the top tax rate, which is if you earn more than 190,000 Australian dollars, you're now paying 45% income tax plus 2% Medicare. Now what that would mean is that that $45,000 tax deduction would give you a $21,000 tax refund if you bought a brand new property with the depreciation allowances. Now you had a holding cost of cash $30,000, so after tax your net holding cost on $1 million property, fully geared to the whole purchase price and the entry cost of 5%, would only cost $9,000 a year after tax. Where that's critical is that means the property now only needs to go up in value 1% a year to recover that cost. So the likelihood of that is certainly good. Now your mission should be pick the property that you think will grow the absolute most, because everything above that $9,000 is your clear profit, less a little bit of capital gains tax, which we'll talk about in a minute. But if the property was not new and you bought it established with no depreciation, you'd still have the $30,000 as a tax deduction, which at 47% would give you a tax refund of about $15,000, not $22,000. So it'd still be very, very good value, but you can see you are incentivized to get a brand new property because it's a bigger tax deduction, and you'd also be helping Australia by increasing the stock of rentals in the market, which would be taking pressure out. But if you buy established, that's not necessarily helping the overall market. Now you can see if you did borrow 80%, if you didn't need to borrow the whole amount or as your first property, you still have a great situation, but the $9,000 is $170 a week is your holding cost on $1 million fully geared. If you had borrowed that property at 80%, you can see the tax refund is almost enough for it to be break even. So your net holding cost is $12 a week on $1 million property with an $800,000 mortgage rented out after tax. And therefore, it's not a significant burden for you to buy a brand new investment property if you can, as long as you've got confidence in its ability to keep rising in value. Now you have the choice with this tax refund to either get it as a lump sum at the end of the year when you lodge your tax return, or you can apply to the tax office and say, hey, can I have my tax deducted from my salary lowered to reflect this refund each and every week, depending on your circumstances which you want. But you can see it's extremely tax effective to be able to buy a property with debt tax deductible in Australia. But does it make sense financially? So what I've done here is this is a capital gains tax analysis that if we sold that $1 million property in 5 years' time, and I've just assumed for the sake of reference that we made an average of 6% per annum capital gains on that property. Now some people might say that's too high, some too little, but do the research on the property you're looking at to make sure you feel comfortable in its ability to do so. Now mathematically, $1 million property in 5 years' time with a 6% growth would be worth $1.3 million in 5 years' time. So you can see if we take off the original cost of $1 million, the stamp duty, we've got the selling cost, the net capital gain when we sell that property would be $260,000 of profit, and we only have to pay tax on half of that. The reason being, if you own the asset more than 12 months, then half of it is tax-free. Now importantly, that 12-month period is from the date of the contract being signed, not the date of settlement. So if you buy off the plan, it's the day you signed the contract to buy it, even though it may be getting constructed over the next 1, 2, 3 years, your 12 months starts the day of the contract signing, not the day of settlement. Now half is tax-free. That leaves $130,000 as taxable. So even if I use the maximum tax rate of 47%, the capital gains tax on our $300,000 profit would be approximately $60,000. Now that's not too bad. We've made $260,000, we're paying $60,000 in tax, and we could use that $200,000 to reduce our home mortgage on our private house, to invest in the next property, to go on a holiday, to help the kids, to do anything at all. It's yours after tax. It's quite a good rate of return. And if you work out the effective rate, it's about 23.5% of the net profit, which is significantly less than your personal tax rates. So you're encouraged to make capital gain because the tax rate on that is half of what it would be if you made the same amount of money as income. Now you can see importantly, when we look at the after-tax return, the return on funds invested, we paid literally no money down when we bought this, but we have had that $9,000 a year after-tax holding cost. And when you factor everything in, we get left over after paying the tax, recovering our costs, paying off the loan, $150,000 of spare cash once we close everything out. Now we started with zero because we used the equity in our family home in this case. So we made $150,000 and all we've done is put $9,000 a year as annual holding cost. So the effective rate of return of having $9,000 a year in this to make $150,000 after tax is like earning 39% on your term deposit. So that's a serious amount of after-tax dollars. So if you are utilising equity in your current home or other investment properties, that is a very compelling motivation to go get your next property using the equity as a deposit and then recycling it into more profit in the future and keep rolling. So that's very, very compelling if you can get a loan, if you have the equity. Now, even if we look at the 80% loan situation, we've still got the same amount of capital gains tax because the tax payable has no bearing on whether we borrowed or didn't borrow. That has a large impact on what our holding cost is, how much we got back as a tax refund, etc. But it doesn't impact the capital gains tax. So that's still 60 grand. But when we pay back the loan, pay the tax, cover our costs, we're left with more money, $400,000 instead of $150,000. But that's because we started with $250,000 of our money right at the beginning, and then we put a little bit less along the way. The effect of that is it's like our return on our money deployed, the 200,000 deposit, the 50 grand cost, and the annual holding cost is like earning 7.8% in a fixed deposit, as opposed to 39% if we put less money in and use the equity. So it's very, very valuable to use the equity if we can, if you have it. If you don't have it, you need the deposit, but still 7.8% after tax is still a fantastic return for anyone looking to be out there in the property market and seeing how they go. If we have a look at the reliability though of the property, can it be sustainable? It's all great that it works out mathematically like that, but how safe are we to keep investing in the market? Has it gone too high? Will it keep going? That's the worry that we all have. And in this situation, you can see there is significant potential in the market. In fact, the market has been doing really, really well, and we are in a period, I think, of sustained outperformance for the next few years. And there's some key reasons for that, and I've listed them below. But you can see in doing that, the returns at the moment in Sydney, Brisbane, Adelaide and Perth are stellar. 6% Sydney, 15% in Brisbane, 15% in Adelaide, 23% in Perth. Now, I do not think that double-digit growth is sustainable year in, year out. That's not the case. We've had a little bit of a surge, particularly in Brisbane, Adelaide and Perth, but it should normalise back towards the long-term averages of 5 to 10%. But at the moment, there's enormous pressure in the market which is driving these prices up. And when you factor in the rental returns, it's quite good indeed. Now, these are the key things that are driving it. It's not speculation, it's not investors, it's certainly not foreign investors, but what is happening is our natural population growth is huge in Australia right now, particularly post-COVID, but even prior to COVID, it was one of the highest in the Western world. And I'll show you that in a moment. But more particularly, we're seeing a scenario where a lot of people are late life upsiders, as I call them. And what that means is they didn't have children like they did in the old days when they were 20. They're waiting till they're 30, 35, 40 to have children, which means that they're financially stronger at that time and therefore more demanding and capable of buying more expensive, more valuable properties in better suburbs and driving the price because they now have a need that they didn't before. We're also seeing migration and expats coming home as a key factor in this, and quite often they are coming with significant amount of cash in order to not even worry about borrowing on their purchase price and therefore outstripping people at mortgages. And then we've got the baby boomers downsizing in a significant level, particularly out of Sydney, releasing a significant amount of sale proceeds, all capital gains tax free if it's been their family home, and then downsizing into other states or other suburbs around. And that is the big driver of the Australian property market now, and will continue to be so for the next 5 to 15 years as these people sell out at prices that they can't quite believe, and more than they need to replace it with another home, renovate the other home, make a possible contribution to super, and still have massive amounts of cash left over like they've never had before. And that's one of the key things that's driving the Australian market, and is not likely to change anytime soon. One of the other things that we've seen over many years is the fact that in our Western society, sadly, divorce is very common now with about half of people getting divorced. And what a lot of people don't realise in the property market is when someone gets divorced, we now need 2 housing units where previously we only needed 1. And that's putting way, way more additional pressure in the property market than it used to in the good old days. And that's something that people are not factoring in. And I don't see that trend changing in the future. And then you also throw in the fact that people are becoming more and more affluent. In Australia, the weekly earnings is higher, the capacity to get money from their parents that might be downsizing, get money from the digital economy, save, double incomes. All these things have changed in our society to make people more affluent. Now, it doesn't necessarily make it easier to get in the door on a house, but it certainly lets you focus if you've got the discipline and determination to hopefully get closer to buying something than before. What I have noticed is those people are tending to want to go straight to their best property rather than progress through not so good, a little bit better, really nice, that's my end property. But we do have a big issue in Australia with long-term undersupply. And both governments, Liberal and Labor, have been very much asleep at the wheel in terms of stimulating this. Again, they've made the cost of land tax, stamp duty, foreign surcharges, they've made them greater and greater every year, thus making it that it's a deterrent to be an investor. As prices get higher, entry points go up. And there's not enough room there. Now, the Albanese government is committed to build 1.2 million homes over the next 5 years. They will be lucky to achieve that target. And even if they do, it's probably not enough anyways, given all the other forces at play. And what a lot of people don't realise in Australia is that on a world scale, Australian property is actually extremely affordable for what you get. Pound for pound, like for like, similar for similar, I haven't found anywhere in the world that is as good value as Australia. And when you throw in all the other lifestyle advantages of being in Australia, I don't see that changing. So I think you're going to find that migration, demand from overseas is going to continue to increase into the future, which is going to continue to put pressure on prices for a variety of reasons, all of which are lifting prices up. So that should mean we should be in a period of overperformance, not underperformance as we go. Now, Melbourne didn't do very well because its population went backwards during COVID because all the students left and there was vacancy. But as you'll see here, that sort of changed pretty quickly. Now you can see this is, in this chart here, is the amount of percentage gain per quarter over the period. Now in COVID right here, we were one of the only people that said COVID would be good for property, get hold of one, and as you can see, it shot prices up. Now that was largely because of the fact that interest rates went down, no doubt, but it was also the fact that people said, hey, if we're going to be locked up, let's get locked up in the best place possible. It had foreigners, expats saying, hey, we weren't coming home, we weren't migrating. Let's do it sooner than later. Let's get down there now. So we saw a surge, which was not the first time we've had that sort of dilemma. Normally when there's bad stuff going on in the world, the Australian property market does very well because it's a great place to live. Now we can see that the market obviously cooled and slowed as interest rates skyrocketed very quickly upwards. And I do think that was bad strategy on the RBA. They put rates up too fast and they cooled the market from fear. Not from natural forces, but pure fear. And as a result, as soon as people realised that interest rates had stabilised and normalised, we've seen the escalation of prices once again return. And I don't think that's going to stop anytime soon because people are starting to come to the factual realisation that interest rates are back where they have always been and are not going to go back to the COVID lows because that took an extraordinary tragic event such as a pandemic. And if you can see with COVID, everybody is pretty much at peak except Melbourne, which has struggled to get everyone back, which I'll show you in a sec. Hobart and the likes not doing too well, but it had a great surge for a while. But everyone's pretty much at peak, and I still think that's tip of the iceberg. One of the reasons I believe this to be the case is because normally when the prices are going up fast, people say, hey, I will procrastinate and I will rent for a while and I'll worry about it later. But at the moment, there's no rental property available. The supply and the availability in rentals is the tightest it's ever been, and we've got no new supply of any great nature coming through, and we've got a building industry that is on its knees. It can't get itself sorted, and we've also got the governments, as I mentioned, with land tax, with stamp duty, being greedy, and raking in billions of dollars, and happy to do so. Narratively, they're out there saying, oh, we want to do anything we can to slow down the cost, make it affordable, but they've got that at their disposal by reducing things like stamp duty, reducing land tax, encouraging investors, but they are not attending to that in any way, shape or form because they're bringing in so much cash at the moment. So these things would normally be places we could hide and soften things off, but that's not the environment of the day. And of course, interest rates are not going to go down much, they're not going to go up much, they're pretty much where they should be. This is the key graph, I think, of all of them, and it's the migration. And you can see here, Australia's migration increase to to September 23, was 2.5%, which was the highest on record. Now, it's going to slow a little bit from that naturally, but it's going to stay pretty high. And even in the September 22 numbers at 1.6, that's pretty big compared to some of our past numbers. But what you have to bear in mind is that this 1.6 or this 2.5 is not only similar in percentage, but it's bigger in size because it's on a higher base number. We're now sitting with 27 million people in Australia, so 2% of 27 is a lot more than 2% of 25. And you can see here, Melbourne in particular, it had a negative growth during the COVID years where all the students left and left a lot of vacancy in the market, but they've all come flooding back with a 2.9% population growth in the year to September 23. And WA has got an incredible 3.3% population growth to the year September 23. That is one of the highest in the world, and it's coming with long-term genuine effect. And these are the things that push prices up, because if we cannot build enough houses to satisfy these people, then competition kicks in. Now, roughly about 150,000 of this growth is births, is net births. So there's families being created, which is those late lifers, etc. So there's pressure in every part of the market, in every part of Australia. And that's what's going to happen, I think, for the next 2, 3, 4 years. This surge is not going to slow down anytime soon, because Australia is a great place to live, a genuine place to live, and is highly desirable on the world scale. Now you can see here, the rental market is probably the biggest indicator of safety. And you can see the Australian average now for vacancy, as at May 24, was 1.5%. Now that is the lowest we've had for a long, long time, historically ever. Now you can see it's come off from what was, 3 something percent. A year ago it was 3.3%. Now the national average is 1.8. A large portion of that is the fact that Melbourne, it's just still high at 2.8, dropped its vacancy by 1.4% from 4.2 to 2.8 in that 12 months, which was largely because of the students coming back into that economy. And you can see in places like Sydney, 1.7, super low, but Brisbane, Perth, Adelaide, under 1% is unheard of. And there is no pipeline of supply coming into the market to be able to satisfy this. And Perth is a classic example. You've got record low vacancy at a time when you've got record high population growth. The pressure on rents to go up, on prices to go up, is getting stronger and stronger and stronger. And I think this is going to be a period of opportunity for 2, 3, 4, 5 years at least. So it's a great time to be entering the market, getting your tax advantages and working it out. And this vacancy is the one that I would keep my eye on in the future, because if this blows out, that's when risk returns in the market. But there's no way that this can blow out unless we build more homes. That's all we can do. And we can't build enough. As a result, you can see the long-term averages, the last 5 years, Sydney 6.8%, Melbourne 1.5 hasn't done that well, but with all that population coming back, expected a lift. And Brisbane, Perth, Adelaide done pretty nicely. But people forget, Brisbane and Perth weren't doing that well for quite a few years, just kicking in now. Sydney's had a really good run, and is now very expensive at 1.5 average, okay? But all of these lead to safety. Only Darwin recorded a negative growth over the last 10 years. So you can invest with confidence into something decent, and then use leveraging and the tax man and the tenant to help you afford, prosper, and save your tax dollars and get that long-term gain. Because remember, if there's not the genuine belief that you can make long-term gain, it's not worth losing money through negative gearing on any property investment. Is it the right time to enter? Well, I think it is. I genuinely do. I think there's never been a better time to be an owner of a property and renting it out. Ironically, with the costs of land tax and stuff, there's also been never a worse time because you're being hit with higher and higher costs. But this quandary of should I cop the burden to get the benefit, I think still weighs on the side of take the benefit. The potential of the property going up because of the lack of supply is strong. But where you need to start is get your finance sorted first. And the reason is it's got harder and harder to get a loan with prices going further and further up and with interest rates coming back to their normal levels of around 6 to 7%. So there's no point punishing yourself and tormenting yourself to go out and look for a property unless you know you can afford it. So I would start my journey with my finance broker, get my pre-approval, assess my equity. Should I borrow 100%? Do I have cash to contribute? Have that conversation at the start so you know what can you afford, what should you buy, what should you go looking for, and then adjust your expectations to that. And if you can get that loan, then absolutely categorically you should go look for a decent property and go get it. Why? Well, if you've got that surplus equity to borrow the 100%, you've got the surplus cash flow to afford the $9,000 holding costs, and you're going to get all of those tax deductions, and save that tax, then the strength in the underlying market should well reward you for doing so. And particularly if this could be a future home, if it could be a future downsizer, and if it's going to help you work towards being less and less in debt by selling off an investment property or an investment to reduce your private debt and have a smaller private mortgage at a later time. The mission should always be, how do I get to be low debt, no debt on the home that I want to end up living in? And if you can buy that now at today's price rather than tomorrow's, if you can make some money with an investment property or two along the way, so by the time you're living in it, you can sell it and reduce the mortgage, that is how you can get in the door cost effectively. What you do need to be mindful of is that, all that glitters is not gold. Just because the property market has great fundamentals doesn't guarantee that you're going to make profit. In fact, what we have seen in the Australian property market is a split in the market between what I call livable property and then rentable. The properties that are going up the most are the properties that are the most desirable to live in. The better suburbs, the better quality, the better build. And the reason is that most of the people coming into Australia, most of the activity is for owner occupation. So people want to pay good money for a good house. They don't want to bail you out of a horrible thing. So the better the quality property, the more livable you buy, the more chance of success in the future. Do not think that any property will make you money. If you buy in less desirable areas that you think are going to be good renters, but no one really wants to live there, chances are you might not even achieve any growth on the property. So be very, very careful to make sure that whatever you buy is something that you like and you feel has capacity to grow. There's no magic in this. It's not going to magically make you. You have to do all the hard work. You have to have the equity. You have to fund the loan. You have to go find the property. But the more common sense you use to find a nice property with a good view, a good location, near a good school, close to the city, close to water, whatever it is that you think makes that property more desirable than something else, the more likelihood you will make profit. Don't think it just happens. It happens with logic and common sense. Try and use as much of that as possible. And always err on the side of quality if you can, and then value second. Now, value means you might buy a horrible house, but if it was at a very good, cheap price, that makes it potentially a good profit. But if you buy a horrible house at a high price, good luck making money and you'll probably make a loss. But if you err on the side of quality, even if you think you paid a little bit more for it than you should have, you'll usually be fine in the long term as long as you haven't gone too crazy. And the reason is everyone coming in is looking for a quality property. So if you have one, the competition is strong, the likelihood of success is higher. And I try and say as a simple logic, you better like the property because you won't like the price. It's now a quantum shift over the last 5-10 years in the Australian property market. We're all used to looking for $300,000-$400,000 properties. They're now $800,000 to $1 million. We'd all love to have the cheaper ones. They're getting harder and harder and harder to find. So you won't be able to find the ones that you think are a bargain because the market's too strong. You won't be able to find cheap because price points have moved. So you better find one that's nice. And the nicer, the better. And finally, you've got to remember property is a long game. You're not going to flip it out within 3 months, 6 months. And you want to own it at least for 12 months to get the 50% tax free. But the better the property you have, the longer you keep it, the longer these fundamentals stay in the market, the better chance of success. So pretty much we're all finished. So I would say to you that not only is property still very, very tax effective, but it's also very opportunistic at the time. Hopefully that's given you a good idea into what you need to look at as an investor. As always at SMATS, we're here to help you do that. Good luck with your investing. I hope you get a nice property just for you. Thank you.